In 2021, the average American mortgage payment was around $1,400 a month. By 2023, same house, same neighborhood, $2,100 a month. Nothing changed about that house. No renovation. No new amenities. The neighborhood didn't get better. The bond market changed. Most people blamed the Fed. Some blamed inflation. But both of those are just symptoms. The real answer, and the thing that actually controls all of it, is something most people have never spent 5 minutes understanding. And right now, in 2026, that same bond market is sitting on $39 trillion in US government debt, and sending signals that most people are completely ignoring. Today, that changes. Let's start from the beginning. The US government spends money constantly on infrastructure, healthcare, defense, social programs. But here's the reality. And the government almost always spends more than it collects in taxes. That gap is called the budget deficit. And every year it continues, it stacks onto the total national debt. Right now, that debt stands at $39 trillion. And the interest payments alone, not paying down the debt, just the interest, have hit $88 billion per month. That's more than what the US spends on defense and education combined, every single month. So where does the government get this money? It borrows it, directly from you, from banks, from pension funds, from foreign governments, by issuing bonds. A bond is simple. The government says, lend us your money. We'll pay you back in a set number of years. That's the maturity. And every year until then, we'll pay you a fixed interest rate. That's the coupon. Your original investment is the principal. You become the lender. The US government becomes the borrower.
Now, here's where most people check out. But this is actually the most important part of the entire video. There's a fourth term called the yield. And yield is different from the coupon. The coupon never changes. If a bond pays 4%, it will always pay 4% of the face value, fixed, forever. But the price of that bond changes every single day because investors are constantly buying and selling bonds in the open market. And when the price changes, the actual return changes with it. That return is the yield. Here's the rule. Memorize this. Bond prices go up, yields go down. Bond prices go down, yields go up. Always. No exceptions. Simple math. If you buy a $1,000 bond paying $40 a year and the price drops to $800, that same $40 payment is now a 5% return on your $800. Price fell, yield rose. Nothing else changed. This inverse relationship drives interest rates across the entire economy. Your mortgage, your car loan, your student debt, your credit card rate. All of it moves with bond yields. The bond market isn't just a corner of finance that institutions care about. It is the price tag on money itself. So who actually controls these yields? Most people assume it's the Federal Reserve. And yes, the Fed controls short-term rates. But long-term bond yields are set by the market, by millions of investors around the world, buying and selling every second, based on what they think is going to happen next. If investors believe inflation is rising, they demand higher yields to protect their returns. If they think a recession is coming, they rush into the safety of bonds, pushing prices up and yields down. If they think the government is borrowing too much, which right now they have every reason to think, they demand even higher yields to compensate for the risk. This is why bond yields are the market's real-time forecast for the future, not what's happening today. What millions of the world's most sophisticated investors collectively believe is coming next. And when that forecast shifts, everything shifts with it. Now here's the trap that should genuinely concern you. A huge portion of U.S. debt is in short-term treasury bills, bonds that mature every 6, 12, or 18 months. When they mature, the government doesn't pay them off. It issues new bonds to cover the old ones. This is called rolling over the debt. When rates are low, this is manageable. But when rates rise, which they have significantly since 2022, every new batch of bonds costs more. The interest burden grows. And with $88 billion a month already going to interest, the government has less money left for everything else: healthcare, infrastructure, social security, defense. And the only solution? Borrow more, which increases the debt, which increases future interest payments, which requires more borrowing. This is the cycle. And the bond market is the scoreboard showing exactly how deep in it we are. Here's how this directly hits the stock market and your portfolio. U.S. Treasury bonds are considered the safest investment on earth. The yield on a treasury is what Wall Street calls the risk-free rate, the baseline return you can earn with essentially zero risk. Now think about stocks. Companies can go bankrupt. Prices can collapse overnight. So investors only choose stocks over bonds if they expect meaningfully higher returns than that risk-free rate. That gap between expected stock returns and the risk-free rate is called the equity risk premium. Here's what that looks like in the real world. In 2022, the 10-year Treasury yield went from 1.5% to over 4% in less than a year. That same year, the S&P 500 dropped 20%. Same companies, same earnings, same economy. Bond yields moved, and $8 trillion in stock market value disappeared. That's not a coincidence. That's the mechanism. When bond yields rise, safe bonds become more attractive. Stocks become less attractive. Money rotates out of equities into fixed income. And trillions of dollars move fast. This is the actual reason behind every "rates are rising, markets are dropping" headline you've ever seen. Not panic, not random volatility. The bond market repricing everything around it. Now here's the one signal inside the bond market that has predicted every major U.S. recession for the last 40 years. Almost nobody outside of Wall Street talks about it. It's called the credit spread. Not all bonds are government bonds. Companies borrow money too by issuing corporate bonds. But companies carry more risk than governments. They can go bankrupt. So investors always demand higher yields from corporate bonds than from safe government treasuries. The gap between those two yields is the credit spread, also called the high-yield spread. In calm markets, this spread is tight. Investors aren't worried. But when fear enters the market, when investors start pricing in defaults and recession, that spread widens fast. Corporate borrowers suddenly look much riskier. Lenders demand more return to compensate. Historically, every time you've seen credit spreads widen sharply, a recession followed within months. The bond market saw 2008 coming before most investors did. It showed up in the spreads first. Before the headlines, before the crash, before it hit anyone's portfolio. So here's the bottom line. Everyone watches the stock market. It's loud, moves fast, makes headlines every day. But the stock market is reactive. It responds to what's already happened. The bond market is where the real signal lives. It's where the cost of money gets decided. It's where governments get priced. It's where the earliest warnings of economic trouble appear. Before it hits the news, before it hits your 401k, before it hits your life. $39 trillion in debt, $88 billion a month in interest, a deficit of $1.9 trillion projected for this year alone. And right now, April 2026, credit spreads are starting to move. The signal is already there. Whether anyone's listening is a different question. Drop a comment below. Do you think the U.S. debt situation is sustainable? Or are we headed for a crisis? I read every single one. Now you know how to read the most important market in the world.